How OpenAI raised billions and changed startup funding forever. In this episode of Capital Compass, we explore OpenAI's groundbreaking fundraising journey from launching as a nonprofit in 2015 to raising over 11 billion and reaching 86 billion valuation. Learn how OpenAI navigated the capital landscape with unconventional capped profit model, partnered strategically with Microsoft, and still attracted top-tier VCs like Thrive, Sequoia, Khosla Ventures, and A16Z. We break down OpenAI's unique structure, the timeline of the funding events, Microsoft's strategic role, and the key lesson for early-stage founders. Case study: How OpenAI raised capital. From non-profit to one of the most valuable AI companies in the world, how did they fund it? Who backed them? And what can founders learn from this radical approach? Let's start with the origin story, how OpenAI started as a non-profit. Back in 2015, OpenAI was launched as a non-profit research lab with a bold mission to ensure that artificial intelligence benefits all of humanity. Elon Musk, Sam Altman, and others seeded the organization with a $1 billion pledge. But here's the catch. Most of that was pledged, not wired. That meant that they had a mission but did not have the money yet to scale. This brings us to the problems with being a non-profit. Now, AI research is extremely capital intensive. You're hiring top-tier engineers, buying compute infrastructure, and running massive training experiments. By 2018, OpenAI realized that a traditional non-profit model won't support the level of innovation that was required to compete with the big tech. This brings us to the capped profit pivot. Now, this led to OpenAI's radical pivot. They launched a capped profit structure. In 2019, they created a for-profit arm, that is OpenAI LP, governed by a non-profit entity. This meant that the investors could make up to 100x of their investment. After that, all profits are directed to the non-profit's mission. And why 100x? Because that's the multiple that aligns with early-stage venture capital expectations while still capping the downside risk for humanity. This brings us to the Microsoft partnership. In 2019, OpenAI struck gold, or rather Azure. Microsoft invested $1 billion, but it wasn't a traditional equity investment. The deal included exclusive access to OpenAI's models for enterprise deployment, co-branding, and preferential compute access via Microsoft Azure. This partnership was a strategic move. Microsoft wasn't just funding, they were embedding AI into their core ecosystem. Now here's the timeline of the major funding events. It started in 2015, as you can see, where OpenAI launches as a nonprofit with $1 billion in pledged donations. And then in 2019, there was a reorganization into a capped profit LP structure. And in the same year, that is 2019, Microsoft invests $1 billion, structured as compute plus partnership. In 2021, Khosla Ventures and others invest quietly, terms were undisclosed. In January 2023, Microsoft commits another $10 billion in a hybrid deal, which is a mix of equity, compute, and future revenue share. In the same year, that is 2023, the estimated private valuation exceeds $29 billion. In 2024, that is last year, Thrive Capital, Sequoia, Anderson Horowitz, Founders Fund, and Tiger Global participate in a tender offer led by Thrive at 80 billion plus valuation. In the same year, that is 2024, a further tender offer from the employees values the company at 86 billion. So what makes OpenAI's raise so different? This wasn't a typical startup playbook. Key differentiators include, first and foremost, a capped profit model that still attracted top-tier venture capitalists, a strategic investor that doubled up as a customer, that is Microsoft, a phased fundraising path from donors to strategic partners to institutional venture capitalists, and then tender offers that allowed employees liquidity before the IPO. And finally, if you're a founder, what lesson can you learn from all this? First and foremost, your capital model can be creative. You don't have to mimic the typical YC play. Secondly, strategic alignment matters more than valuation early on. Third, create multiple paths to liquidity, not just IPO. And fourthly, you don't need all the money upfront, just smart money that unlocks scale. In closing, we can say that OpenAI didn't just raise capital, they redefined the rules. As a founder, you may not need $1 billion deal, but you can learn from how they aligned their funding model with their mission, attracted strategic partners, and stayed focused on the long-term value. This is the Capital Compass series wherein we decode the journey of capital one startup at a time. Today, we did our first case study, that is OpenAI, but do stay tuned in for more.